You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 11th of June 2024, and I'm joined today by my co-host John McEwen. And in this week's episode, we'll be discussing Pets at Home, AutoTrader, British Land Co., Doc Martens, Tate Lyle, and our US company of the week is Fiverr. John, do you want to start us off with Pets at Home? I suppose it's a bit of a favourite of the show now.
It is, and I think it's just been what we'd always expected from a company like this. I don't think we'd necessarily seen the resilience and quite how well a traditional bricks and mortar retailer could do, aside from your Nexts and Zara's. I guess initially when we started the show, Kingfisher was sort of up and in there too. But anyway, Pets at Home, pet retailer, had their full year results out with full year underlying pre-tax profit in line with the downgraded expectations of £132 million, which was down 3.2% on the previous year. The performance reflected weaker profitability in the retail business because of the distribution disruption and higher sales of lower margin products. This offsets the overall group revenue growth of 6.9% to £1.9 billion, including strong growth from the vet business. There was a 1.6% increase in the number of active pet club members to 7.8 million. And that's the sort of VIP scheme, very important pet, little bit like the Tesco club card scheme. Including lease liabilities, the group ended the year with net debt of £369.2 million and free cash flow was 29.7% lower at £69 million. And a buyback of £25 million has been announced. Full year dividend of 12.8 pence per share is in line with last year, including a final dividend of 8.3 pence. And the outlook for the new financial year is unchanged, including underlying pre-tax profit of around 144 million. And the shares were broadly flat following these results. In terms of valuation, Pets at Home has a market cap of £1.38 billion and forward priced earnings of 12.5, compared with a 10-year average of 15.8, and it has a prospective dividend yield of 4.8%. I mean, I think with these results, broadly in line with guidance and what we come to expect, I think you did see the group really booming after the lockdowns and obviously people buying more pets, particularly dogs, and they've done very well off the back of that. Also integrating all of the services, making it kind of somewhat hybrid in terms of bricks and mortar and bringing the vets, I should say, for your pets in-house. So I think all of those things have been good, not quite as good at the moment. And there are, I think, a few headwinds and headaches when it comes to some of the competition and markets. And I suppose the alleged price fixing when it comes to veterinary fees, which is a slight issue for the group. I probably wouldn't be rushing and buying shares. I think they're fairly priced. It is a good quality stock, but it wouldn't be one for me right now. Sam, what are your thoughts on these full year results?
I thought they were okay. I know the profit's a bit disappointing, but I think given what's been going on economically in the past 12 months, it kind of makes sense that you would have people where obviously they still have to feed their pets, but some of the niceties they might have also been buying when times were a bit better, they seem to have cut back on. So I do think that explanation does kind of make sense. I think the revenue growth is still quite good in spite of that. I know it's not fed through. I know you've mentioned the issues with the vet business, but there was strong growth in the vet business, and I don't see why that wouldn't continue. Number of Pets Club members increased. I know it was only 1.6%, but I just think there's a lot of things where it's, I think these are very temporary problems, and the sort of the underlying core figures that you'd be looking at were moving in the right direction. So when things start to recover, I don't think it'd be too long before it was roaring away again. I agree that a forward PE of 12.5, I think it's pretty fairly valued, just because although I do think there's opportunity with the vets business, it's also pretty saturated. I just think 12.5 is pretty fair, really, but I do think it's a very, very good business, and I do like it. But yeah, I think it's pretty fair given the year they've had, but I think the year's not actually as terrible as it might look on the surface.
of a few of the retailers that we do cover regularly on the show, where would Pets at Home sit with the current valuation for you?
I think it'd be up there. Next, I think it would probably just put on a bit of a pedestal. I think it's just a phenomenal business. I would put it above Kingfisher, although that, Kingfisher and B&M, although they have both dropped off since COVID. But then you've even got the ones where they're not quite as good as Next, but you've got sort of, I guess I'd put it in line maybe with Dunelm, something like that. I think a year ago I would have put it in line with ABF, but I think ABF have been doing so well that they're probably up there with Next now, really. What about you?
Yeah, I think definitely below ABF, below Next. Obviously, Zara does do incredibly well, does come at a higher valuation. Yeah, and I probably would say above Kingfisher too. I suppose it's not right up there, and it's not a sector that I really love. So I think probably for that reason, whilst it does have quality attributes to it, I wouldn't be rushing to buy shares, and it sort of lower down there on the watch list. It's certainly been on there for a while, particularly when times were slightly better, and you had that pet boom post pandemic before inflation really started to feed through and have the effects that it has done. But yeah, okay. On to another very high quality business, one that we both like, AutoTrader.
Yes, AutoTrader. So they have come out with their full year results. Just look them up. Group revenue is up 14% to 571 million, and that was split between AutoTrader revenue increasing 12% to 530 million, and Autorama revenue increasing 51% to 41 million. And Autorama is the leasing business. The operating profit was up 26% to 348 million, and the AutoTrader operating profit margin was up 1% to 71%. The group operating profit margin was up 6 percentage points overall to 61%. I think that's quite a bit lower because I'm assuming the leasing is just lower margin compared to the AutoTrader, which makes sense given that AutoTrader will basically be pure profit. The earnings per share were up 13% to 28.15p a share, and the cash generated from operations was up 16% to 379 million. They have returned 250 million to shareholders, and that's up from 225 million a year ago, and that's split between 170 million of buybacks and 80 million of dividends. The average revenue per retailer grew 12%, and they were 10x larger than their nearest classified competitor, and UK retailer forecourt numbers were up 1%. The used car retail market has been robust throughout the financial year, which they expect to continue, and demand is resilient, with cars continuing to sell faster than before the pandemic, and used car supply has gradually improved. New car retail market has been more challenging, and discounting has started to return. And their Deal Builder product, which is part of their digital retailing strategy, enables car buyers to value their part exchange, apply for finance, and reserve a car on AutoTrader. The product is still in trial phase, but scaling well, with approximately 1,100 retailers on board at the end of March. Over 75% of all minutes spent on automotive classified sites were spent on AutoTrader. Cross-platform visits were up 11%, 77.5 million a month, and cross-platform minutes were up 8% to 553 million per month. In terms of the valuation, the business trades at a PE ratio of 28 and has a dividend yield of 1.18%. I think these are a very, very good set of results. I think it's really quite hard to knock the results. I also think, I don't know how big the Autorama business could get, but you've also got potentially quite a bit of growth in there. And I think that's probably, obviously the great results help, but I think that's probably why it's now slightly higher than historically we've seen it. It's normally kind of been in the 20 to 25 PE range, and it's now up to 28. And I appreciate the results are excellent, but I think the fact that you've potentially got that Autorama growth as well could be a contributing factor. I really, really like this business. It's on the watch list. I used to own it. I regret selling it.
Can we ask how much you sold it at?
It would have been around probably £6 a share.
Okay.
Something like that. But it was at that level for years and years. And in fairness, I think when I sold it, I put it into Rightmove because I did have both of them. From memory, I think I just thought, well, just go in on the one that I like the most. And I've done pretty well on Rightmove, so I wouldn't shed any tears. I do have others you can shed tears over.
Yeah, I was going to say, I think you're probably, just in terms of that short-term chart performance. Probably would have done a bit better on AutoTrader, but I appreciate that's short.
Yeah, but I have done well on
Right
Rightmove. So yeah, so I'm not, at least I didn't put it into Boohoo or something. But yeah, I mean, I do regret selling it if I think, but I think at the time I was wanting to concentrate my portfolio a bit more, and I just thought, well, AutoTrader and Rightmove are two very similar businesses. I just thought, well, I'll just go in on the one that I think is better. But yeah, it's a business I would like to own again in the future, I think, actually. But I don't think I would want to own it at 28 times earnings. So it would probably have to drop quite a bit for me to actually take a serious look at this again. But if you are a shareholder that has held on, and well done, because it is an excellent business. And I'm not sure I would sell it at 28 times earnings. I just wouldn't buy it. What about you, John?
Yeah, no, I think fairly similar. I think it's a fantastic business. I've actually recently put my car on AutoTrader. I've used AutoTrader lots of times in the past, and it's great. I think also it's interesting what they're doing, because they're not staying purely as, just a place where you can list sort of classifieds online, as you mentioned, with Autorama. And also, I think from looking as well as selling sort of HPI type searches and products. So you can have, you can search and you can check your car base, or check the car that you're looking to buy, and make sure that its history checks out, hasn't been stolen, written off, outstanding finance, all the rest of it. So lots of extra products that you can buy. I suppose it does come down to the growth, and where does it go from here? I appreciate the argument is that into some of those things that we've just mentioned, but that when it is 28 times earnings, I guess is a concern. Although it's a fantastic business, and I do really like it, but I probably wouldn't be brave enough to buy shares in it at the moment.
Should we move on to British Land Co then?
Yes, so British Land Co. we haven't covered for a while. It's a real estate investment trust that had their full year results out, with full year net rental income falling by 1.3% to £440 million, driven by disposal and some asset refurbishments. Higher fee income and lower costs helped underlying profit rise by 2% to £268 million. Estimated rental value, ERV, rose by 5.9%, exceeding guidance in all sectors. Total occupancy across the portfolio was 97%. And rising interest rates early in the year affected the valuation of the group's portfolio, falling by 2.6% to £8.7 billion. And values were broadly stable over the second half. British Land's loan to value rose to 37.3% from 36%, reflecting lower valuations and higher capital expenditure. In the coming year, ERV growth is expected to be between 3 to 5% across all markets. And the board has proposed a final dividend of 10.64 pence per share, taking the total for the year to 22.8 pence, which is up 1%. And the shares were broadly flat in early trading. In terms of valuation, British Land Co. has a market cap of £3.93 billion, and it trades at a forward price to book of 0.72, compared with a 10-year average of 0.73, so almost identical. And in terms of its dividend, it's got a fairly chunky one at 5.7%. I thought these results were fair. I think we are, continuing to see things improve, albeit gradually. It's obviously much more difficult for a company like this when interest rates are higher, and that's something also that's going to affect the valuation of the properties. I don't get particularly excited by it. I think growth is very mild, and I appreciate it's cheap, but I think there are lots of question marks over, retail in the 21st century and going forward. They have adapted things a lot, and they're doing sort of this campus portfolio, which does seem to be working better, have very high occupancy, which is also great. And they're looking at the science and technology sector in that sort of same campus strategy. But I still think it's tricky. I think from an e-commerce side of things, there are some other companies, for example, Segro, that are probably more orientated towards that, which arguably in this sector is sort of where a lot of the growth is. So yeah, I'd probably not go further with British Lanco. You could look at it, dig into the value a bit more and, debate as to whether some of those assets are, how undervalued, if you think they are on the balance sheet. But for me, I probably just wouldn't go further at the moment. Sam, what are your thoughts on British Lanco? Were you a former shareholder several years ago?
Yeah, this is another one I used to own as well. So this one I bought mainly. It was decent. I think it is a decent read, but I mainly bought it for the diversification. That was my thinking behind it. And then decided I didn't like it because there was no growth, which I don't know why I expected. But because it's quite hard for REITs to grow, because one of the conditions is they have to pay out 90% of their profits as a dividend to keep the REIT status. So I should have known that when I bought it. But anyway.
Out of interest, how long did you actually hold it for?
I think I only held it for a year or two and basically broke
Okay.
even on it. I think I probably
Yeah.
did slightly better than break even with the dividends because they were about
Yeah.
5% at the time. So I probably actually did okay on it. But yeah, I just don't know. I just don't know what I was doing.
What do you think of these results?
So I think they're okay. It's pretty similar to you. It's nothing to write home about. I just don't like the mix of what they own, I don't think. I think I don't find it particularly exciting. I think there's a lot in there that concerns me, not necessarily based on the figures, but sort of just based on, the type of property they own. We've covered it before on the show, not for a while, but if I was to buy a REIT again, I would go with Tritax Big Box REIT. I think that's with the caveat I've not looked at the results recently, but I prefer what they own. I find it more exciting. I can see where the growth is in the values a lot easier. It's not quite as stodgy. And for anyone who's not familiar, Tritax Big Box REIT, they basically just do like big industrial units like the Amazon warehouses and stuff, like those kind of buildings where it'll be like near a motorway, absolutely massive, very well connected, and they will build those and rent them out. And that's basically their business model. But you can kind of see with the growth of e-commerce and stuff like that, where the growth comes from, because they could not buy anything and still have the values increase probably quite significantly if they're building sites in smart areas or buying sites in smart areas. So yeah, I don't think it's a terrible business. The yield's pretty good, but I guess you can get that in a bank now. So almost what's the point when there's no growth would be my attitude to it. But it's a decent REIT. It's just not for me, I don't think.
Fine. Okay. Shall we move on to another company that we've covered a few times and has been struggling since it listed?
Yes. So Doc Martens, the makers of the boots that every teenage girl seems to have a pair of, which then lasts them until they're about 40.
Part of the problem.
Exactly. Too well made. That's the problem. But they have come out with their full year results, and revenue was down 12.3% to 877 million, although that was only down 9.8% in constant currency. The direct consumer revenue mix was up 9% to 61%. EBITDA was down 19.4% to 197.5 million. EBITDA margin was down to 22.5% from 24.5%. Profit before tax was down 42.9% to 97 million. Basic earnings per share was down 45.7% to 7p a share. Net debt was up from 288 to 357 million. They even announced a cost action plan across the group with targeted savings of 20 to 25 million. And they've said that the direct consumer revenue was up 2%, and that's 5% in constant currency, and that was offset by wholesale revenue, which was down 28%, primarily driven by USA wholesale. Within direct consumer, retail was up 6%, and e-commerce was broadly flat. And by region, Europe, Middle East, and Africa was down 3%, with 12% growth in direct consumer offset by wholesale decline. And that was driven predominantly by the planned strategic decision to reduce volumes into Europe, Middle East, and Africa e-tailers. American revenue declined 24%, driven by wholesale. Asia Pacific and China revenue was broadly flat, driven by good growth in Japan. They opened 35 net new stores globally. They had successful supply chain strategy. The successful supply chain strategy delivered continued savings, supporting gross margins, which increased 3.8% to 65.6%. And here's probably my least favourite bit of this. Net debt increased to 357.5 million, up from 288 million, due to returns to shareholders, lower profits, and increased lease liabilities. Inventory is flat year on year, in line with expectations. I'm not sure why net debt's going up to increase shareholder returns when they're struggling. So the dividend has been cut in half, however. In terms of the valuation, the business trades at a PE of 12 and has a yield of 3%. these results are pretty poor. There's no getting around it. I don't like that the debt's going up and they're still paying out a dividend. I appreciate it's been halved, but I just think cut it to zero and sort the business out. I don't know how I feel about this one. I feel like a chop and change every time I cover it. I do think there's a good business in there. I think it's a really strong brand. I know that they only seem to really do the boots. I know they do other stuff, but you Doc Martens, you think of the boots. But I think there's a very good brand there. You would think with what we've seen with sort of Nike, that direct consumer does represent an opportunity. I know the direct consumer revenue mix is already quite high, but that's because they have a lot of their own stores in city centres. In terms of the online, I think there's probably still a lot of potential to grow that. And you'd think it's the kind of brand that carries well to Asian markets, which, as we've seen, for example, with Burberry, that there's not that demand that there was 2 or 3 years ago, maybe. But I think if they can cut out the unprofitable sort of wholesale and retail stuff, replace it to direct to consumer, sort of have it as a desired brand in Asia. And I would caveat this that we've seen this story with Burberry, and it's easier to identify the problem than to fix it. But I do think at the core of Doc Martens, there is actually a very good product and potentially a good business. At 12 times earnings, I don't know if I would take a punt on it, because I think it's probably actually quite fairly priced given the issues that they're having. But I think there is actually a price at which I would be interested in it. I don't know what it is. I'll probably know it when I see it. But it's not 12 times earnings. What about you, John?
Yeah, it's definitely not 12 times earnings for me. And yeah, I think there's a big turnaround that needs to happen. And I'm not really buying into it, to be honest. And it's not a brand that I know it's not about what I personally like, but it's not one that I really love or I could see. And I think the US side of things is very disappointing too. So yeah, I'd just be staying away. I appreciate it's a lot cheaper than it was, but no, not for me, Sam.
Oh, actually, I forgot to do the share price. So since they listed, in 3 years, the share price is down 82.94%. So if you did buy shares on the IPO, you've been absolutely happy. It's basically just gone down ever since it listed.
Yeah. And justifiably so, really.
Yeah, and there's not really anything in these results to suggest in the short term that won't continue either. Because although, I do think there is a potentially good business in there, I don't know at what price I'd want it. And also, I'd rather, not that I would, I think buy it at the minute, would have to probably drop quite a bit more. But with businesses like this, I wouldn't want to catch the falling knife. I think I want something where it's almost like an M&S type scenario, where you look at M&S now, and yes, you've probably, you could buy it today and not get in at the best price if you bought it a couple of years, as compared to if you bought it, say, 3, 4, 5 years ago. But you can see in the M&S results when we cover them that the turnaround is actually happening. It's not something they're talking about. It is very much happening. I don't see that with Doc Martens yet, and I'd rather pay more for a business where you can actually see that turnaround process has already begun.
Yeah, no, I would agree with you there.
Right, should we move on to a debut on the show?
Is it a debut? Have we not covered
I can't remember.
Maybe I feel like we've covered it maybe once a long time ago. So Tate & Lyle, which is predominantly sugar, but it's best known for its golden syrup. Anyway, they had their full year results out with a 2% decline in full year revenue to £1.6 billion, driven by lower volumes and customers destocking. However, strong pricing and a proactive mix management helped underlying cash profit EBITDA rise 7% to £328 million. Free cash flow rose by £49 million to £170 million. And that reflected an improvement in overall cash conversion. And meanwhile, net debt fell by £85 million to £153 million, or 0.5 times cash profit. Revenue is expected to be slightly lower in the coming year, but cash profit is forecast to grow between 4% and 7%. A sale has been agreed for the remaining stake in its US joint venture, Permanent, for $350 million. The plan is to return the net proceeds through a share buyback. And a final dividend of 12.9 pence a share was announced to bring the full year dividend to 19.1 pence a share, which was up 3.2%. And the shares were up 1.2% in early trading. I thought these results were pretty fair. I think, if I'm not wrong, we did cover it maybe shortly after the pandemic. And I think there was quite an uptick with more people baking at home, and that did very well. I'm not really sure what to make of it, because I think, yes, it has the Lyle's golden syrup. But beyond that, it feels like it's, almost purely sort of commodities. And that's not something really that I would want to be in. And also, it's the sort of company, and whilst there's more to it than traditional sugar. It's something that with sugar taxes and healthy eating, predominantly here in the UK, I think it could be quite significantly targeted and hit by. So that does put me off it quite a lot. If we looked at it though from a valuation perspective, it's got a market cap of £2.7 billion, and it does trade at just 11.5 times forward earnings, compared with the 10-year average of 12.4, prospective dividend yield of just over 3%. So it's not expensive, but it's not one that draws me in, and I wouldn't be interested in either from a valuation perspective or for growth, really. So to be honest, the analysis doesn't go that much further, and it just wouldn't really be one for me for those reasons. Sam, do you have any thoughts on Tate Lyle?
Broadly agree with you. So I was going to say the same thing, that it just looks like a commodity, really. I've had a look at the website and the products because I'm not massively familiar with the brand, and it does look like it is basically just sugar. It's not an industry I know loads about, but we have followed ABF for a while, and they have the, what's it called? Silver spoon sugar, I think it is. And I know it's only a small part of ABF, but covering that over a few years, you see it's a very, very volatile commodity. I think they probably all are, in fairness, but I just think, it might look fairly all right at 11.5 times earnings, but I don't know what the sugar price is going to do next year. So for me, I just wouldn't go any further. It might be a very good business, but I wouldn't want a business that was basically, I'm just relying on the price of sugar to drive my returns. And I know there's probably more to it than that, but in the short term, that is what's going to make or break the next set of results, probably. And I just don't want that.
Yeah, no, fair enough. Okay, then on to our final company of the week.
Yes, so it's a company we've covered multiple times before, Fiverr. So we covered it, we've covered it really since we started the show. Covered it at the height of COVID, when it was one of the hot trendy stay-at-home stocks, trading at over 40 times revenues, something ridiculous. It's no longer trading at that level, as we will get to. Fiverr, they are a platform for outsourcing. So it's, if you want a job doing, and basically pay someone online to do it. So as an example, our intro was Fiverr, our logo was Fiverr. So it started because everything was $5 on there, but it's moved on a bit from that, and people just they've just kept the name. That's the only thing on there that's a Fiverr now. But it's a pretty good website if you want anything designy or anything, where it's like, for example, in the UK, it's like, you could spend hundreds and hundreds for someone to design a logo, and the end result is just not very good anyway. On Fiverr, for a much lower budget, you could go and get multiple people to do it and just pick the best one or something like that. It's very, very good for that kind of stuff. If we were inclined to get the episodes transcribed to help our SEO, we could get someone on Fiverr. There's all kinds of jobs like that. I'm just picking the ones that sort of relate to the podcast, but there's all kinds of stuff you can get on there. So they have come out with their first quarter results, and revenue was $93.5 million, and all these figures are in dollars, and that compares to 88 million a year ago, an increase of 6.3%. Active buyers were down 6% from 4.3 to 4 million. However, spend per buyer was up 8% from 262 to 284. Take rate was up from 30.4% to 32.3%, which I think is absolutely insane. So on every transaction, they're getting 32.3% of it. And I actually think that's too high. It's quite impressive that they've got that, but we've covered it for a while now, and I thought that can't keep going up, and it has. But it's surely you get to the point where it's so high that it's actually pushing people away from the platform. And I sort of feel like once you get past 20%, you're kind of in that territory. But anyway, the gross margin was 83.5%, up from 82.2%. And they now have GAAP net income, which was $800,000 or 2 cents per share, and that compares to a loss of 4.3 million a year ago, or 11 cents per share. This I thought was really interesting. So they've authorized a share repurchase program of up to $100 million, which is their first ever share repurchase program, demonstrating their confidence in the long-term opportunity and commitment to creating shareholder value. Our strong balance sheet and cash flow generation enables us to return capital to shareholders and also support long-term strategic investments. I think that's really interesting, because most of the time when you cover a buyback, I will try and, if I remember, I'll try and include the market cap of the company compared to the buyback, so you can get an idea of what it is as a percentage return. So this is up to 100 million. The market cap for Fiverr, the market cap is under 1 billion. So it's
wow, yeah, significant.
Yeah, the market cap's 966 million. So that's about 11% as a share buyback, which is quite interesting. And then you look at, so I don't know over what time period this is. I just know it's just been authorized. It might be over like 2 years or something instead. But again, you go into the financials, and if we look at, so we've only covered the Q1 results, but if you were to look at the cash flow for the last 12 months, free cash flow is 89 million. So they can definitely afford it. And that's 89 million on a 966 million market cap. And this 89 million is not a one-off. It was 82 million the year before. And it was a bit lower before that. It was 27 and 34 and 13. But I think what's happened is obviously with once the growth's they've stopped growing exponentially, I think they've started cutting some of the costs. And it is now starting to look like a very, very profitable business. I know that's not showing through in the net income, but in terms of the cash it's generating, probably quite similar to Etsy in that sense, where it's just churning out cash now. Not that's covered because the net income looks horrendous, but I suppose you don't care as long as you're getting a 10% share buyback a year as a shareholder. In terms of valuation, it trades at a PE of 112. The buyback's about 10-11%, and it trades at 11 times free cash flow now. I thought these results were okay. They're not the results it was putting up in the pandemic, obviously. It's disappointing that the active buyers has gone down. If you told me it was the sellers, I probably wouldn't have been as surprised given how much they're charging, but the buyers is disappointing. However, those buyers are spending more. I suppose similar to what we saw with Pets at Home, where it's just that kind of economy where, if you have to cut back on something like this, maybe you do. It's like a lot of the stuff, maybe it's stuff you can do without, or you just sort of increase the gaps before you need it. But whatever way you paint it, the active buyers going down isn't good. However, in terms of the valuation this thing's now at, and it's actually pretty similar to last time we covered it, it sort of seems to have leveled out a bit. But it's trading at a share price of just under $25. That compares to a high of $323 height of COVID. Wow. So it's down well over 90%. However, I think it's fallen so low, and this is the business that I own shares in, which I'm down about, I think 60-70% on, and that was after I bought it after about a 60-70% drop. But I think it's so cheap now. Yes, the results aren't perfect. Given how cheap it is, I actually think it's pretty good value. I'd like to cover Upwork in the next couple of weeks and see how it compares. But I think on the surface, I would actually say this is probably a bit of a value play now. It's completely gone from the growth camp to the value camp. But I just think when you get into tobacco level returns from it, I think it's a business that I know I've said it 3 or 4 times, but the active buyers dropping is the most concerning thing. However, revenue is still increasing, and you would hope, given the kind of business it is, the way sort of the tailwinds it would have behind it over the long term, you would think that it can grow. Those growth figures do have the potential to go back up to much larger levels. You'd think in terms of what the potential active buyers are, it's probably a lot higher than 4 million. So I think it is still a business, although it's not showing in these figures, it's still a business, I think, with a lot of growth potential. The gross profit margins, 83.5%, are ridiculous. I think it can get to that level with operating profit margins, and the cash flow seems to suggest that. I really like it. What about you, John?
Similarly, and it's one that I've grown to like the more we cover it.
The more it's dropped.
Well, yeah, well, that basically, because my issue with it in the first place was more one of valuation. It was the same with Upwork and Etsy too. Not that I actually dislike the companies themselves. I will be interested to see how it compares with Upwork. And I think, as I've said in some previous episode, I probably would buy both of them and take more of a basket approach to it in that sense. But I think it is really attractive, and the levels that we're seeing it come down to now. Yeah, I may well take a position, I think.
So of the 6 businesses we've covered this week, Pets at Home, AutoTrader, British Land Co., Doc Martens, Tate Lyle, and Fiverr, which do you like the most and which do you like the least?
Well, I think Fiverr, as I've just said, would be my pick. And what do I like the least? Probably Doc Martens. I mean, it's obviously very different to real estate investment trust, like British Land Co., but the brand, and I think it really is having difficult times. So that's the one I'd be staying away from.
I think for me, it would probably also be Fiverr. I think probably like the least would probably be Tate Lyle. I just don't want the commodity exposure. I think if I wanted it, I would get, buy a basket of commodities. I wouldn't buy something like that. So for me, it's just last by default, although it's not necessarily, in fact, it isn't the worst business we've covered this week. It's just the industry.
Fair enough. Okay, well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.